Most people hear health savings account and mentally file it away as boring adult paperwork, a place your paycheck sends a little money, money in, money out. You forget it exists until something goes wrong. And that's fair because that's genuinely what the account was built for. But there's a version of this same account that becomes a massive wealth building machine. Same account, same rules, completely different outcome. This isn't a new product or something you have to apply for. It's the exact HSA you may already have. And the numbers back this up. By the end of 2025, only about 10% of HSA accounts held any invested money at all. The rest sat there, slowly losing value to inflation, while a small group of account holders were quietly building something much bigger. So today, let's put two people side by side, same age, similar income, contributing the exact same amount into their HSA every single year. One of them is using this account exactly the way it was designed. The other one knows something the first one doesn't. By the end of this video, you'll understand exactly what that difference is, how to set it up for yourself, and where this strategy can go wrong if you're not careful. Section 2. The two ways to use an HSA meet Nora and Miles. They're not related, they don't work together, but their financial lives on paper look almost identical. Both are 34, both earn around $65,000 a year, both are enrolled in a high deductible health plan through their jobs, and both contribute the same amount into their HSA every year. This is not about how much either of them contributes. It's about whether that money is ever given the chance to grow. Nora does what most people do with this account. When a bill shows up, she pays it with her HSA card. Dentist visit comes out of the HSA. Prescription refill comes out of the HSA. By December, her balance is usually close to nothing. And in January, the cycle starts again. This isn't a mistake. It's the account working exactly the way it was built to work. Miles does something different. He still gets sick. He still goes to the dentist. His medical bills are not lower than Nora's. But when a bill arrives, he pays it out of his checking account instead. That one difference is enough to turn his HSA into a 7-figure account. We'll get to exactly how soon. Here's the part worth sitting with. Both of them pay for the exact same care. Neither one is skipping treatment to save money. The only difference is which pocket the money comes out of and whether the HSA is given time to grow. That gap is the entire subject of this video. Here's where it gets interesting. The IRS allows tax-free HSA withdrawals for qualified medical expenses as long as those expenses happen after your HSA was open. But most people don't realize this part. You are not required to withdraw that money the same year the expense happens or the same decade. The IRS never puts a clock on it. That means Miles can pay for his dental work today, keep the receipt, and legally wait 10, 20, even 35 years before pulling that exact amount back out of his HSA tax-free. Let's make this concrete. Say over the course of 1 year, Miles pays $400 for a dental filling, $200 for a prescription, and $100 for an eye exam. That's $700 in documented qualified medical expenses. He doesn't touch his HSA for any of it. He pays it out of his checking account and he keeps every receipt. Years later, once his HSA balance has grown, he can reimburse himself for that exact $700 whenever he chooses. The requirements are simple, but they matter. The expense has to be qualified. It has to have happened after his HSA was open. It can't have already been paid by insurance or claimed as a tax deduction, and it can't have already been reimbursed once before. Keep documentation, and the timeline is entirely up to you. This is what's known as the delayed reimbursement strategy. It isn't a workaround or a gray area. It's written directly into how the account works. It's just something almost nobody uses because almost nobody explains it this clearly. Right now, that's just $700 in one small example. Stretch this same idea across an entire working life, and the number gets a lot harder to ignore. We'll get to exactly how big that can grow in just a few minutes. Now that you've seen the mechanism, here's the quick background worth locking in before we go further. A health savings account belongs to you, not your employer. The money rolls over every year. There's no use it or lose it deadline. And if you switch jobs, the account comes with you. People often confuse this with a flexible spending account or FSA. An FSA is typically tied to your employer, and in most cases, if you don't spend the money, you lose it by the end of the year. An HSA carries none of that pressure. It's yours. It carries forward, and it can stay invested for decades if you let it. That's all the background you need for now. Let's get into why this account is so powerful. This is the part that makes this worth paying attention to. An HSA is the only account that gives you 3 separate tax advantages at the same time. The first is on the way in. Eligible contributions can reduce your taxable income, whether they come from your paycheck directly or from your own contribution. The second is while the money sits there. Any growth inside the account, dividends, interest, capital gains, none of it is taxed while it stays in the HSA. The third is on the way out. If the withdrawal goes toward a qualified medical expense, it comes out completely tax-free. Compare that to your other accounts for a second. A traditional retirement account gives you a break going in, but you'll pay taxes when you take the money out. A Roth account flips that. You pay taxes going in, but withdrawals are tax-free. A regular brokerage account doesn't shield you at any stage. Dividends get taxed, gains get taxed. An HSA used this way can potentially hit all 3 stages favorably. That combination doesn't exist anywhere else in the tax code. One quick note. This is describing the general federal tax treatment. State rules can vary, so it's worth checking how your state treats HSA contributions and growth specifically. Let's run real numbers using this year's contribution limits, not inflated ones. Say someone with individual coverage contributes the 2026 maximum of $4,400 annually across 35 years. Assume a hypothetical 10% average annual return, contributions made at the end of each year, and no withdrawals along the way. That grows to somewhere around $1.2 million. For family coverage, contributing this year's limit of $8,750 under the same assumptions, that number grows to roughly $2.4 million. I want to be direct about something. These are illustrations, not promises. Markets don't move in a straight line. Contribution limits change over time, and fees can eat into returns depending on your provider. 10% is a reasonable long-term assumption, not a guarantee. Either way, the core idea holds. Money that sits invested for decades, sheltered from taxes at every stage, ends up somewhere very different than money that gets spent and refilled every single year. Now, if you're paying attention, you might already be thinking of a problem with this whole idea. If Miles is paying medical bills out of his checking account instead of his HSA, couldn't he just take that same money and invest it in a regular brokerage account instead? Why does it need to go through the HSA at all? That's a fair question, and the honest answer is yes. He could. This strategy doesn't create free money out of thin air. Miles is still committing real cash from his checking account to cover those bills, cash that could theoretically be invested somewhere else entirely. So where's the actual advantage? It comes down to 3 things. First, the tax treatment inside the HSA is better than a regular brokerage account since gains aren't taxed along the way. Second, keeping the money inside the HSA preserves it specifically for future medical costs, which are essentially guaranteed to show up eventually. Third, and this one matters more than people give it credit for, the HSA structure builds in discipline that a checking account doesn't. Money sitting in checking tends to get spent, not out of carelessness, just because it's available. The HSA removes that temptation almost entirely, since touching it requires a deliberate decision tied to an actual medical expense. Let's put a number on it. Say Miles pays $600 a year in medical bills out of pocket instead of pulling that money from his HSA. If he took that same $600 and invested it in a regular taxable brokerage account across the same 35 years at the same 10% return, he'd end up with a similar looking pile of money on paper, but along the way, a portion of that growth would get chipped away by taxes on dividends and capital gains. Inside the HSA, that same growth compounds without any of that drag and comes out completely tax-free at the end as long as it's used for medical costs. Could a highly disciplined person get similar results investing the difference on their own? Sure, but the HSA route gets you there with better tax treatment, and it doesn't depend on you having perfect financial discipline every year for 3.5 decades. None of this works unless you're eligible for an HSA in the first place, so let's cover that quickly. To contribute, you need to be enrolled in a qualifying high deductible health plan. For 2026, that means your deductible has to be at least $1,700 for individual coverage or $3,400 for family coverage. Your total out-of-pocket costs, not counting premiums, also have to be capped at $8,500 for an individual or $17,000 for a family. Take a quick example. Say your plan has a $1,200 deductible and a $5,500 out-of-pocket max. That sounds expensive, but it actually disqualifies you because it doesn't clear the minimum deductible bar for a high deductible plan under these rules. Now compare that to a plan with a $2,000 deductible and a $6,500 out-of-pocket max. That one qualifies. You also generally can't be claimed as someone else's tax dependent, and you can't have other disqualifying coverage, like being enrolled in Medicare. There's a genuinely useful update for this year that most explanations of HSAs haven't caught up to yet. Starting in 2026, certain bronze and catastrophic health plans now qualify for HSA compatible treatment, even though they didn't before. Direct primary care arrangements, where you pay a flat monthly fee for a doctor's office instead of going through insurance, generally no longer disqualify you either. And in many cases, those fees themselves can now be paid from your HSA. There's also permanent relief that lets qualifying plans cover certain telehealth visits before your deductible kicks in without knocking you out of eligibility. Picture what this actually changes. If you're on a bronze marketplace plan with a lower monthly premium, one that wouldn't have qualified you for an HSA in past years because its deductible didn't hit the required threshold, that plan can now make you HSA eligible entirely on its own, starting this year. If you're not sure whether your plan qualifies, check with your HR department or compare your plan's deductible and out-of-pocket numbers directly against these thresholds. Once you know you qualify, funding the account is fairly simple. You, your employer, or in some cases another eligible contributor can put money in. If your employer contributes on your behalf, that amount counts towards your annual limit, not on top of it. For 2026, that limit is $4,400 for individual coverage and $8,750 for family coverage. If you're 55 or older, you can add an extra $1,000 on top of either number. These limits aren't all or nothing. If you can't hit the max, contributing something is still worthwhile. Every dollar in still gets the same three-part tax treatment. One research point worth knowing. Roughly 43% of HSA holders receive some kind of employer contribution, according to the most recently published data from a major industry database covering account activity in 2023. Accounts that got employer money tended to have higher overall balances and were more likely to actually hold investments rather than sitting entirely in cash. If your employer offers a match or contribution, that's essentially free money layered on top of an already favorable account, worth taking if it's available to you. One more thing worth knowing: if you're married, there's no such thing as a joint HSA. Each spouse who's eligible has their own individually owned account. One mistake quietly undoes this entire strategy before it even starts. Opening an HSA and putting money into it does not automatically mean that money is invested. A lot of HSAs default to holding your balance entirely in cash unless you go in and manually move it into investments. Depending on your provider, you might need to keep a minimum cash balance before you're allowed to invest the rest. Some providers only offer a narrow menu of mutual funds. Some charge ongoing account fees or investment fees that quietly chip away at your returns over time. If you're serious about this strategy, look for a provider that lets you invest most of your balance, keeps fees low, and offers broad, diversified fund options. Beyond that, the specific funds matter less than simply making sure the money isn't sitting idle. One statistic puts this in perspective. In that same 2023 database, only around 15% of HSA holders had invested any of their balance outside of cash. More than half of all accounts had a withdrawal at some point during that year, meaning most people are treating this exactly like Nora does, a pass-through account, not an investment account. In practice, that looks like this. Say your provider requires you to keep the first $1,000 of your balance in cash before anything else becomes eligible to invest. If your total balance is $1,200, only $200 is actually working for you in the market. The rest sits there, technically inside an HSA, but functioning no differently than a checking account, quietly losing purchasing power to inflation every year it stays uninvested. If your HSA balance has been sitting in cash this whole time, that's the very first thing to go check. Now, I want to slow down here because this part matters more than the exciting growth numbers from earlier. This strategy is not for everyone, and using your HSA to pay for medical bills right now is never a mistake. That's exactly what the account is for. Paying out of pocket to preserve your HSA balance tends to make sense when you already have a solid emergency fund. You can cover the bill without going into credit card debt. You're not expecting a major medical expense anytime soon, and you have decades left before you'll need this money. It tends not to make sense if you're living paycheck to paycheck, you're carrying high interest debt, you're facing a major procedure, or covering the bill yourself would mean borrowing money just to keep your HSA balance untouched. There's also a middle ground worth knowing about. You don't have to choose one extreme or the other. You can keep a portion of your HSA in cash for expenses you know are coming soon and invest only the portion you're confident you won't need for years. You can reimburse some expenses now and hold on to others for later. This isn't all or nothing. In real terms, that could look like this. Say your HSA holds $3,000. You know you'll likely need around $500 for routine care this year, so you leave that portion sitting in cash. The remaining $2,500, money you're confident you won't touch for years, gets invested. If an unexpected bill shows up that your cash portion can't cover, you simply pay it out of pocket and add the receipt to your records, rather than selling investments at a bad moment just to cover it. Paying 20% interest on a credit card just to preserve a hypothetical 10% return in your HSA isn't a strategy. It's a trap dressed up as one. This entire strategy depends on one unglamorous habit: keeping your receipts. For every expense you plan to reimburse later, hold on to the date, the provider, the patient's name, what the service or item was, the amount, and proof that you personally paid for it, not your insurance. Here's a simple system that works. The moment you get a receipt, scan it with your phone. Save it into a secure digital folder organized by year. Log the expense into a simple spreadsheet with columns for the date, the provider, the amount, where the receipt is stored, and whether it's been reimbursed yet. That last column matters more than people expect. The IRS requires proof that an expense hasn't already been reimbursed once and that it wasn't also claimed as a medical deduction elsewhere. Without a record, you have no way to prove any of that. Decades from now, when your memory of a $400 dental bill from 2026 is long gone, Miles keeps his system simple. Every receipt gets photographed the same day it's paid, dropped into a folder labeled with the year, and logged into a single spreadsheet before he closes his laptop that night. It takes him under 2 minutes per expense. By the time he's 50, he'll have a complete, dated record of every dollar he's ever paid out of pocket, ready to be reimbursed the moment he chooses. This sounds tedious, but it takes minutes a year if you build the habit early. And it's the difference between a strategy that actually works when you're 70 and a pile of unusable receipts. Let's finish the retirement picture. before age 65, if you withdraw HSA money for anything outside a qualified medical expense, that amount gets added to your taxable income, and you'll also pay an additional 20% tax on top of that. It's an expensive mistake. Once you turn 65, that 20% penalty disappears completely. Withdrawals for qualified medical expenses still come out tax-free, exactly as before. But now, if you withdraw money for something unrelated to medical care, that amount is simply taxed at your regular income tax rate, the same as you would with a traditional retirement account. In other words, at 65, your HSA effectively becomes at least as flexible as a traditional retirement account, while still holding on to better tax treatment for anything medical. And in retirement, medical spending isn't hypothetical. HSA funds at this stage can typically go toward deductibles, co-pays, prescriptions, dental and vision costs, certain long-term care expenses, and even Medicare premiums, though Medigap premiums are generally treated differently. Picture Miles at 70. His Medicare premium comes out of his HSA tax-free. A hearing aid he needs that year comes out of his HSA tax-free. A dental procedure that Medicare doesn't fully cover, also tax-free, pulled straight from an account he built decades earlier out of bills he was always going to pay anyway. None of that money ever has to touch his Social Security check or force him to pull extra from a traditional retirement account in a high tax bracket year. This is the piece that completes the secret retirement account idea. It's not just a bucket for bills while you're working, it's a bucket that stays useful for the rest of your life. Let's close this out with the mistakes most likely to quietly wreck this whole plan. Mistake 1, assuming any high deductible plan automatically qualifies. Check the actual deductible and out-of-pocket numbers against this year's thresholds before assuming you're eligible. A plan can look expensive and still fail the technical definition, the same way that $1,200 deductible plan we looked at earlier didn't qualify. Mistake 2, leaving your entire balance sitting in cash without realizing it. Cash makes sense for near-term expenses, but it will never grow the way an invested balance can. If you've never actively gone in and chosen to invest inside your HSA, there's a good chance your entire balance is still sitting in cash right now, exactly like Nora's. Mistake 3, investing money you'll actually need soon. Markets can drop right when a medical bill shows up, and being forced to sell at the wrong time defeats the entire purpose. This is exactly why the hybrid approach from earlier matters. Keep near-term money in cash and only invest what you're confident you won't need. Mistake 4, losing or duplicating your receipts. Reimbursing the same expense twice or claiming it as a deduction somewhere else too creates a real problem with the IRS. A single missing receipt doesn't just cost you that one reimbursement, it can call your entire documentation system into question. Mistake 5, going into debt just to preserve your HSA balance. Paying high interest to protect a hypothetical return isn't discipline, it's a bad trade. No investment return justifies carrying a balance at 20% interest just to keep a few $100s invested somewhere else. Avoid these 5, and this strategy holds up exactly the way it's supposed to. Let's go back to where we started. Nora and Miles pay for the exact same care. Neither one is smarter than the other, and neither one is skipping the doctor to save money. The HSA doesn't make medical bills disappear. You still pay for health care one way or another. What changes is the structure underneath it. The delayed reimbursement strategy simply means today's bill can create a documented opportunity for tax-free money decades from now. The balance sitting untouched gets time that most people never give it. The goal here was never to chase a specific dollar figure. It's to walk into retirement with a dedicated pool of money built specifically for an expense you already know is coming, treated more favorably by the tax code than almost anything else available to you. That bill in your inbox right now isn't just a bill. Depending on what you do next, it might be the start of something a lot bigger. If any of this landed for you, that's really the whole reason I make these. Thank you for spending this time with me today. If you want more of this, subscribing is the easiest way to support the channel, and I genuinely appreciate it. I'll see you in the next one.